Morning, everybody. Thought we'd start by sharing some thoughts on the year that we've seen to date. So I've got a few charts there on the screen, and we'll talk through what that all means. Very much a picture, I would say, of volatility, which is probably no surprise to you. And this is a chart very much of percentages, what's happened since January up until the last week. So if I start on the top left here, this chart of asset performance, I think very interesting to note in the last year, what we've seen so far is very negative returns. So the red there showing negative, and you can see the magnitude of some of the level of returns we've got there down at minus 30% or so for the gilts market, i.e. government bonds, index-linked gilts, again, government index-linked bonds, and corporate bonds as well. And equities generally returning quite negative returns too. So a very negative picture for asset markets. Interestingly, the only asset class that really delivered a positive return there was commodities, which we've illustrated by looking at oil over the period. And within there, a lot of volatility, as I say, within those different assets, and a currency effect too, actually playing quite a significant role as well, as sterling did some weakening over that period. But very negative asset returns. We've then, as I'm sure you're aware, seen this bottom left chart here, inflation very much picking up over the year, driven very much by energy prices and other aspects of supply chain issues, probably the quantitative easing that we've seen over recent years, as well as a policy response to COVID driving through into that figure. And monetary response to that by governments as well, as we've seen play out, which really is the chart on the right here, as we've seen the base rate, i.e. the kind of interbank lending rate, which very much drives mortgages, for example, in terms of their pricing, drift up over the year as well, going up over, as you can see, from sort of pretty close to zero up to 3%. So a very sort of dynamic picture over that period. But very much for pension funds, when we think about what is driving pension funds in terms of funding position and valuation of liabilities, then the gilt yield is very much a key aspect here, and that's this chart on the bottom right. The blue line on the bottom showing the lending rates effectively in the long-dated interest market, effectively the gilt market at the beginning of the year, and the green line showing the rates at the as at now. So you can see significant shift up. So if we take an example there, if we say that sort of the 19-year yield there, about sort of 1% at the beginning of the year, now up somewhere close to 3.5% to 4%. That's a material shift in that yield. And if you think that you could lend to the government effectively at the beginning of the year, the best part of 20 years and get 1% return, you can now get 3.5% return. That increase in yields has an inverse relationship in terms of performance, and that's really driven this negative gilt return here that we see over that period. But of course, valuation of pension fund liabilities is linked to that yield and therefore to that return. So in us seeing that massive increase in yield, which has seen the negative performance, you've also seen a significant drop in pension fund liability values come through over that period. And that's very much a key message, I think, for pension funds. So the game has certainly moved on there, and I think moved a lot of schemes more towards their end game in terms of funding positions improving. As a broad rule of thumb, around about a 20-year duration is probably where the average pension scheme is. That 2% increase in gilt yield has probably dropped the liabilities of the order of 30 to 40% over that period. So a significant change in valuation of liabilities in a very short period of time, which is really, I think, is kind of that dominant picture over the year to date. So just to zoom in a bit more then in terms of what actually happened with that gilt yield, and yes, it's moved up, but what's really driven that? So here we're showing a much shorter period of time, beginning of September to the end of October, and plotting the chart of what's actually happened to gilt yields. And here we focus again on the 20-year gilt yield, which is the sort of average term to payment of many defined benefit pension schemes. And we can see a combination here of green and grey. We've tried to distinguish the green as really, if you like, political events, and the grey is more the Bank of England policy events coming into effect. And we can see that there was a significant increase in yields as we went through September. The mini-budget particularly spiking those increasing yields as the unfunded tax cuts weren't particularly well received, resulting in the Bank of England intervening in the market, which essentially means they were prepared to buy bonds to reduce the yield and keep the prices high. And we saw the benefit of that policy kick in at the end of September, and then again it sort of waned as we went through October, when some of the unravelling of the budget happened and the tax cut being scrapped, as you can see. And all really is coming to a head here towards the end of sort of the third week of October, when the Bank of England intervention ended, the change in the Chancellor, ultimately the Prime Minister, and more of a settling of yields and volume in the gilt market returned pretty much to normal. And by volume I mean, it was quite interesting actually, over this period there was very little trading that was going on. So yields were moving and prices were changing, but very few actual bonds were changing hands, which is actually very interesting. But we have seen a bit more of stability now in yield markets. But certainly we're still at sort of yields of 3.5% between that area, which is much significantly above where we were at the beginning of the year. So that definitely has impacted many schemes' funding positions. And that has implications in terms of thinking about investment strategy and where schemes might be positioned now. I thought it worth touching as well on liability-driven investments, because you may have heard and seen this in the press. There were some very strong headlines. My own personal view is a lot of these headlines were very much overdone. For example, a headline of illegal LDIs blamed for gilt chaos. I don't understand how they've suddenly become illegal, given that the regulator's been telling schemes to use them for a number of years, and certainly legal advice has been that they are permissible. So that's quite a change in focus. And we see other sort of headlines in terms of gilt market, being burnt down and pension funds collapsing. That didn't really happen. There was a run on liquidity. Some pension funds were struggling to get liquidity to maintain their hedges, i.e. their match of assets to liabilities. But the worst that really happened if they couldn't maintain their liabilities was that some of the hedge unwound, and that wasn't a dramatically bad position. So it was a very difficult time in the gilt market, and a lot of schemes were stressed, but perhaps not as bad a headline as was being made out here. In terms of outlook, so thinking about where markets might go from here and some of the key driving factors. So some points to think about. In terms of corporate balance sheets, yes, we've seen a rise in interest rates, we've seen a rise in inflation, and we've seen a rise in the price of corporate debt as well. So yields have increased on corporate debt, which has reduced their value, but it's meant that refinancing for corporates is more costly now than it was. However, a lot of larger company balance sheets still remain quite strong. They're not stressed, they've got good earnings, and they've got good cash flow. So there is quite a supportive case there for a number of, I think, equity markets and for a number of larger companies. Some of the factors that I think we'll see come to bear and play out. We mentioned there an end to plentiful supply of energy. We're all aware that energy prices have increased. It's likely, given that policies around energy prices will mean that sort of over the next few years we will see energy prices remain higher, and they will for a while definitely feed through into the inflation figures, but those will probably come down, and we expect those to come down next year. And supply chain disruptions, particularly, as an example, what we're seeing at the moment in China with the COVID lockdowns, China being a significant source of materials and also development of goods to the global economy. That's having some serious effects in supply chains, which is affecting the world generally. In terms of the interest rate and the inflation aspects, which is really the monetary policy, I mentioned higher interest rates, so that will have a bearing, and inflation as well having a bearing, but we think that inflation probably has has peaked and will likely come down over the next year as energy prices somewhat stabilise and therefore help that inflation level retrench. And really in the backdrop to that, in terms of what assets might be attractive, well, I've already mentioned that some equities potentially have some good upside. There's likely to be a demand and a wish to invest in projects on infrastructure, particularly around renewables and anything related to sustainability, something that seems to be very popular at the moment. So that will likely be an area in which will get more attention. And certain areas of credit, so corporate debt, where we've seen corporate spreads widen, which effectively means that debt becomes cheaper. I think certainly some areas of that refinancing which present very good opportunities for clients who would want a sort of diversified credit type portfolio. And then we mentioned a couple of other factors on the bottom that I think we'll see play out in terms of industrial unrest. Well, obviously we're beginning to see more strike action, so we say, in the economy, and certainly a labour shortage and a withdrawal from some of the labour supply. At the moment we have very high percentage of the population that is uneconomically active and actually choosing not to work, which is quite an interesting dynamic, which is feeding through into some of the inflationary issues again. And then a globalisation of policies around things such as sustainability. We saw a similar aspect again with response to COVID happen, and that will likely drive and sort of synchronise economies going forward. So in terms of perhaps keywords for 2023, thinking ahead, volatility is likely still going to be high. Yes, we've seen quite a bit of downside in markets, but that risk is still there and still being priced in. So that will be a key determinant, I think. And then sustainability as well, in terms of how that plays through in the drive to net zero and the changes that means to corporations and how they adapt to that. That will be another key player that we'll see. So what does it mean for schemes generally? So going back to the point about assets basically cheapening off, and particularly what we've seen in gilt markets, that's moved many pension schemes' funding positions. Many actually to the better. And it's been quite a, I suppose, perverse picture in the sense that you would think that when growth assets are falling, the situation is bad, but actually it's been more than offset typically by what's happened in gilt markets, and therefore, as I say, funding positions typically stronger. And that gives an opportunity to potentially lock some of those gains in. So it actually takes schemes closer to their end game. If their end game is buyout, if their end game is self-sufficiency, many schemes have sort of had a bit of a push along that path, which has been very helpful. So thinking about whether there is an opportunity to de-risk assets, I think is one thing to be aware of at the moment, and also to monitor and prepare for what the next step might be. What we saw recently with the spike in yields is that it happened very quickly, and there's a relatively short window to take advantage of those very high yields. If you were lucky enough to do that, you were probably a pension scheme that had thought ahead in terms of how you were going to do that. So actually having that plan, I think, sort of stepped out as for your next step for de-risking if events present themselves such, is very helpful. In terms of the liability hedging aspects, a lot of headlines about LDI. I mean, liability hedging is still a good, robust thing to do. There are some differences now in how you would do a liability-driven investments portfolio. Leverage is lower, you might have to allocate more assets to that type of strategy, but it's still something that has a very strong place in portfolios as a risk management tool. I think another point there on the liability hedging is to think about income. As schemes mature, income becomes ever more important. So thinking about how you can work assets into your portfolio which will have good income generation going forward, that will actually match the cash flow out of the scheme, and reliable income generation as well, which is a crucial factor. And then really for the asset portfolio, as I mentioned, volatility is key. There are a lot of risks out there. So not effectively the old saying, putting all your eggs in one basket, thinking about being diversified, both in terms of asset type, by geography as well, globally. We've also said here, be aware of your investment beliefs, and that really ties into ideas around sustainability and development around sustainability. Quite often I think people will have ideas about how they wish to invest, and that might not actually be replicated in their portfolio. So sometimes it's quite interesting just to look if there are any gaps between what you think you have in your portfolio and what you actually do. Can prove quite an interesting exercise. And then, as I say, I think there are some areas in which there are quite good, promising longer-term returns. And certainly predictions across the market now, we're seeing a lot of commentators predicting very strong returns over the next 10 or 20 years, particularly from equity markets. So potentially a lot of upside looking forward. That's all I wanted to say on markets. Then pause for a second and see if there are any questions before we move on.
Do you think the headlines on the LDIs were due to a lack of understanding of risk within the press, say the government?
I think that is, to a degree, yes. There was more risk, I think, to some of the fund managers than there was to some of the pension schemes. And what I mean by that is the funds that they're running are quite heavily geared. So when we saw rates begin to rise quite rapidly, the value of those funds fell very heavily. And some of them actually fell below zero over a couple of days, we think. That put immense pressure on the fund managers to recapitalise those funds, because they're having to basically pay margin and post collateral on those funds. Sorry, a bit of a technical term, but that's what they're having to do. And that meant that they were under significant pressure to get the value of those funds back up above zero, effectively. So I think that was more of the stress, which then compounds itself, because when the value falls, they have to sell gilts that they're holding, which again forces the price of gilts down and the yields further up. So there was this bit of the cycle that developed at fund managers where they were being forced to sell the asset that was becoming ever cheaper, and the cheaper it got, the more they had to sell. And that did become a sort of bit of a self-reinforcing downward spiral.
Just to follow up, if I may, then, reading the press, there is a debate about who's responsible for the lack of regulation or that situation happening.
Mm-hmm.
Who do you see responsible? Personally, I think it's the FCA, but that's my lack of understanding, I guess. How do you see it between the various bodies?
There seems to now be an attempt for people to obviously to discuss this. There is select committees going on, and there seems to be different fingers being pointed in different directions, I think it's fair to say. Certainly now what we're seeing is, and what we're hearing is, the LDI managers are under much tighter scrutiny, and they are having to get clearance from the FCA before they actually take certain actions. So for example, some LDI managers have recently redistributed cash to clients. So we went through a period where they were asking for lots of cash. Now as yields have settled, they're paying some cash back, but before they're doing that, they're asking for regulatory approval and a green light to do so. So that's a combination of discussions with the Bank of England, with the FCA, and I think there will be and it's certainly ongoing, the discussion about where the future regulation will lie.
Thank you.
The position changed so rapidly.
Sorry, I can hear the voice. Okay.
Yeah, you hear the voice and didn't see where it's coming from. The position changed so rapidly, and we've seen it peak and come down, and you made comments about if you moved, you had improved your positions. To do a movement in that sort of time scale is impossible.
It's difficult, yes.
Yeah. Because you've got to move money from one to another and all the rest. Yeah. Is that a sign that the pendulum is swinging in the opposite direction now? Whereas we saw a benefit in our liabilities as that rocketed down the other way. Is the pendulum moving in that direction, that we suddenly will see that our liabilities will go up? Because we won't put a lot of money into saving our LDI.
Yes, so I think a lot of schemes obviously transferred a lot of cash across to LDI, so that has seen a repositioning of their overall portfolio in terms of the allocation that they have to growth type assets and the allocation to LDI, so that's one consideration. And you can see there, latter half of October there was a significant fall. It seems to have steadied off a little bit around kind of just above 3% in terms of longer dated yields. That's not to say it won't come down from there, and I know some of my colleagues argue that it will. But I think there's more reason now to suppose that looking forward, given the inflationary factors, given where we are with global growth and what seems to be an end to cheaper money supply in the system, particularly a reversal of what's been known as quantitative easing, where effectively governments have been printing money, one would expect that those factors perhaps would be supportive of a higher rate, longer dated yield going forward. So it looks like for the time being we've settled just above 3, and maybe that will be, and that's what longer term predictions at the moment seem to say. And I think that might be a reasonable expectation. I would just note that in terms of where we are, if you compare the UK rate to the US long dated rate or the European sort of Bund rate, we are higher, about 1% or so higher. So you could argue that there's still perhaps some room in terms of normalisation across the globe for a slight reduction in our rate. Sorry?
Of about a percentage point?
If we were on parity, you could argue that was the case. Yeah, I think there are still some concerns about weakening sterling potentially, and I think some perhaps drags on the UK economy that might be resulting from for example, for Brexit and the legacy there that might give us a little bit of a higher rate looking forward, particularly the weakness around sterling.
Okay, thank you.
It was very much along the same lines actually, it would be really sharp to lock in the gains at the big gilt yield there when you
Yeah,
pension schemes are not nimble enough to.
Agreed, and it was a quite a short-term window that opened up there.
Yeah. So is there still?
Yes, there is.
The same response. Is there still an opportunity to lock in some gains?
I think so, because we've had rates hovering around 1.5% for a long period of time, and many schemes have set their investment strategy around those rates and the funding assumptions linked to those rates. Given that we're now a bit higher, I think that's could be supportive of, again, still thinking about the de-risking point. I think the other point to make there is, when I mentioned earlier about preparing for the next step, it is possible to plan in what your next de-risk step would be in terms of your portfolio, and then think about how you would monitor the changes in the market such that when they occurred, you might be a little bit speedier to get things implemented.